You're seeing the headlines everywhere. RSI above 70. Technical analysts calling for a pullback. CNBC bringing on the bears. Gold's overbought, they say. Time to take profits. And if you're sitting on gold positions right now, maybe you're getting nervous. Maybe you're thinking about selling. Maybe you're wondering if you missed the top. Let me tell you something. This isn't 2011. This isn't 2020. What's happening right now in the gold market is fundamentally different from anything we've seen in the modern era. And if you sell based on a simple RSI reading, you might be making the biggest mistake of your investment life. Because here's what they're not telling you on CNBC. Here's what the technical analysts with their pretty charts are missing. The entire structure of the gold market has changed. The buyers have changed. The reasons have changed. And the old playbook? It doesn't work anymore. Let me show you what I mean. Right now, gold is trading around $4,000 an ounce. That's double where it was just 2 years ago. The relative strength index, that classic overbought indicator, has been flashing red for months. Every technical analyst worth their salt is calling for a correction. Mean reversion, they say. What goes up must come down. But here's the thing about RSI. It measures momentum. It tells you when something has moved too far, too fast. It's designed to catch tops and bottoms in normal markets. Markets driven by sentiment. Markets driven by retail investors chasing trends. This isn't that market anymore. Let me take you inside what's really happening. Because the story of gold in 2025 isn't about technical indicators. It's about the largest wealth transfer in human history. It's about central banks abandoning a 50-year experiment. It's about the unraveling of the dollar system itself. And it started quietly. So quietly that most people missed it. In 2022, something unprecedented happened. Central banks around the world bought 1,136 tons of gold, the highest annual purchase in 55 years. Not since 1967, when the London gold pool was collapsing, had we seen buying like this. But here's what made it different. In 1967, central banks were trying to defend the gold standard. They were trying to keep gold at $35 an ounce. They failed spectacularly, and Nixon closed the gold window 4 years later. This time, they're not defending anything. They're accumulating, aggressively, deliberately, and they're not stopping. Through October 2025, central banks have bought another 254 tons. But that's just the official number. That's what gets reported to the IMF. The real number? Nobody knows. Because China stopped reporting their gold purchases years ago. Russia's buying through intermediaries. The Middle Eastern sovereign wealth funds? They're not exactly broadcasting their moves. And here's where it gets interesting. Because this isn't about diversification anymore. This isn't about having 2% of your reserves in gold for tradition's sake. This is about something much bigger. Let me tell you about a meeting that happened in Kazan, Russia, in October 2024. The BRICS Summit. 40 countries attended. Not just Brazil, Russia, India, China, and South Africa anymore. Saudi Arabia, UAE, Egypt, Ethiopia, Iran. Countries representing 45% of the world's population. Countries controlling 40% of global oil production. And they talked about one thing: how to trade without dollars. Now, you might be thinking, they've been talking about that for years. Nothing ever happens. And you'd be right. Until now. Because something changed. Something fundamental. In February 2022, the United States and European Union froze $300 billion of Russian central bank reserves. Just like that. Money Russia thought was safe, held in dollars and euros, became inaccessible. Not because Russia defaulted, not because of any legal process, because of a political decision. And every central bank in the world watched. Every finance minister, every sovereign wealth fund manager, and they all thought the same thing. If they can do it to Russia, they can do it to us. That's when the buying started. That's when gold went from a 2% portfolio allocation to a strategic imperative. But here's what makes this different from every other gold bull market in history. It's not driven by inflation fears. It's not driven by currency debasement. It's not even driven by geopolitical tension, though that's part of it. It's driven by trust, or rather, the complete collapse of trust in the dollar-based financial system. Let me give you some numbers that should terrify anyone holding dollars. In 2000, central banks held 71% of their reserves in dollars. By 2020, that had dropped to 59%. Still dominant but declining. Today, it's below 55% and falling fast. Where's that money going? Gold, yuan, euros, even Bitcoin in some cases, but mostly gold. Because gold is the only asset that's nobody's liability, the only asset that can't be frozen, the only asset that every central bank in the world will accept. And here's the kicker. The total value of all central bank reserves globally is about $12 trillion. If they're moving from 55% dollars to, say, 45% dollars, that's $1.2 trillion that needs to find a new home. If even a quarter of that goes into gold, at current prices, that's $300 billion of buying. The entire gold market, all the gold ever mined in human history, is worth about $18 trillion. A $300 billion shift? That's not a ripple. That's a tsunami. And it's already started. Goldman Sachs just raised their 2026 gold price target to $4,900 an ounce. Not because they're gold bugs. Not because they're predicting hyperinflation. Because they're modeling continued central bank buying. Because they understand what's happening. But let's talk about that RSI reading. Let's talk about why the technical analysts are wrong. RSI works in sentiment-driven markets. Markets where weak hands chase momentum and strong hands fade extremes. Markets where overbought means too many buyers and sellers will soon overwhelm them. But what happens when the buyers aren't weak hands? What happens when the buyers are central banks with unlimited fiat currency and a strategic mandate to accumulate? What happens when the buyers literally cannot stop buying? Let me tell you about another market that went overbought and stayed there. The Swiss franc in 2011. The Swiss National Bank was trying to cap the franc at 1.20 to the euro. Every technical indicator said the franc was overbought. RSI above 70 for months. Traders kept shorting it, expecting mean reversion. Then in January 2015, the SNB gave up, removed the cap. The franc soared 30% in minutes. Hedge funds blew up. Retail traders lost everything because they were trading technicals in a market driven by central bank policy. This is that market, except this time the central banks are buying, not selling, and they're not going to give up. They can't give up, because the alternative is staying in a system they no longer trust. Now, I know what you're thinking, but gold has to correct sometime. Nothing goes up forever. Even if the long-term trend is up, shouldn't I wait for a pullback? And in a normal market, you'd be right. But let me show you what happens when you wait for pullbacks in a structural bull market driven by institutional buying. In 1971, when Nixon closed the gold window, gold was $35 an ounce. By 1974, it hit $195, a 450% gain in 3 years. The RSI was overbought the entire time. Traders kept waiting for the pullback. The pullback came briefly in 1975. Gold dropped to $140. Then it went to $850 by 1980. If you waited for the right technical setup, you missed a 24x return. In 2001, gold was $255 an ounce. By 2008, it hit $1,000. Overbought the whole way. Traders waited for mean reversion. The pullback came in 2008 during the financial crisis. Gold dropped to $700. Then it went to $1,900 by 2011. If you waited for the perfect entry, you missed a 7x return. And here's the thing about those bull markets. They were driven by inflation fears and currency debasement. Real problems, but ultimately cyclical. The Fed could raise rates, tighten policy, and eventually kill the gold rally. This time is different. Because this isn't about inflation. This is about the architecture of the global financial system. And you can't fix that with interest rates. Let me paint you a picture of what's coming. Because the central bank buying, that's just the first wave. The second wave is already building. Institutional investors, pension funds, sovereign wealth funds. They're watching what central banks are doing, and they're starting to follow. Total gold demand in Q3 2025 hit 1,313 tons, the highest quarterly total on record. But here's what's interesting. ETF flows are still negative. Retail investors are still selling. The price is going up despite retail selling, because the institutional buying is overwhelming everything else. And when retail figures it out, When the financial advisors who've been saying gold pays no yield for the last decade finally capitulate? When the 60-40 portfolio gets rebalanced to include a 5% gold allocation? There are $50 trillion in global pension assets. A 5% allocation to gold is $2.5 trillion. The entire gold ETF market is $250 billion. You do the math. But let's talk about something more immediate. Something that could happen in the next 72 hours. Because there's a technical setup developing that has nothing to do with RSI. The COMEX gold futures market. Right now, open interest is at record highs. But here's what's interesting. The commercial traders, the big banks that usually short gold to hedge their physical positions, they're not short anymore. They've been covering. Aggressively. At the same time, the managed money traders, the hedge funds and CTAs, they're not as long as you'd expect. They're actually underweight gold relative to their typical positioning in a bull market. What does that mean? It means there's no crowded trade to unwind. It means there's no massive short position waiting to cover. It means the usual mechanisms that create sharp corrections aren't in place. And here's the scary part. If we get any kind of catalyst, any kind of shock to the system, those managed money traders are going to rush in all at once. And there's no liquidity to absorb that buying. Let me give you a scenario. It's January 2026. The Federal Reserve is still trying to manage inflation without crashing the economy. They're stuck between 3% inflation and rising unemployment. The dollar is weakening. Treasury yields are rising. The deficit is exploding. Then China announces they're opening a gold-backed trade settlement system. Not a gold-backed currency, just a mechanism for countries to settle trade in gold instead of dollars. Voluntary. Opt-in, but available. What happens to gold? What happens when every exporter in the world realizes they can get paid in an asset that's appreciating instead of a currency that's depreciating? What happens when the petrodollar system, the foundation of dollar dominance for 50 years, starts to crack? Gold doesn't go to $4,500. It doesn't go to $5,000. It goes to $7,000, maybe $10,000. Because at that point, it's not about investment returns anymore. It's about survival. It's about having the only asset that works when the system breaks. And the technical analysts will still be talking about RSI. Now, let me address the elephant in the room, the gold IRA question. Because if you're sitting on $100,000 or more in retirement accounts, you're probably wondering how to get exposure to this without liquidating everything and buying physical gold. I put together a free guide on how gold IRAs work. It's in the description below. Covers the mechanics, the tax implications, how to roll over existing retirement accounts without penalties. It's not for everyone, but if you're in that situation, it's worth understanding your options, because the window to position for this might be shorter than you think. Anyway, back to the market structure, because there's another piece of this puzzle that nobody's talking about, the physical market versus the paper market. Right now, there are about 100 ounces of paper gold traded for every ounce of physical gold that actually moves. The COMEX, the LBMA, the gold ETFs, they're all fractional reserve systems. They work fine as long as nobody asks for delivery, as long as everyone's happy trading paper claims on gold. But what happens when central banks start asking for physical delivery? What happens when sovereign wealth funds want their gold in their own vaults, not in London or New York? It's already happening. Germany repatriated 674 tons from New York and Paris between 2013 and 2017. It took them 4 years to get their own gold back, and they had to accept different bars than they deposited. The serial numbers didn't match. Now, multiply that by every central bank in the world, every sovereign wealth fund, every institution that's realizing paper gold isn't the same as physical gold. The squeeze is coming. Not today. Not tomorrow. But it's coming. And when it does, the price of physical gold is going to decouple from the price of paper gold. The premium for physical delivery is going to explode. And if you're holding paper gold, you're going to learn a very expensive lesson about counterparty risk. Let me tell you about 1980. Gold hit $850 an ounce in January. The RSI was at 95, the most overbought reading in history. Every technical analyst said it had to crash. And they were right. Gold dropped to $300 over the next 2 years. But here's what they don't tell you. In 1980, Paul Volcker raised interest rates to 20%. He deliberately crashed the economy to kill inflation. He made the dollar the highest-yielding currency in the world. He gave investors a reason to sell gold and buy bonds. Can Jerome Powell do that today? Can he raise rates to 20% when the federal government is paying $1 trillion a year in interest at 5%? When the deficit is $2 trillion and rising? When the entire financial system is built on cheap money? He can't. And everyone knows he can't. That's why this time is different. That's why the 1980 playbook doesn't work. Because the Fed is trapped. They can't raise rates enough to make the dollar attractive. They can't tighten enough to kill the gold rally. All they can do is manage the decline, and the market knows it. That's why gold keeps going up despite being overbought. That's why central banks keep buying despite the price, because they understand what's coming. Let me give you another data point. The gold to S&P 500 ratio. Right now, it takes about 1.5 ounces of gold to buy 1 unit of the S&P 500. That's elevated, but not extreme. In 1980, it took 0.3 ounces. In 2011, it took 0.5 ounces. If we're in a real monetary crisis, if we're in a real loss of confidence in the dollar system, that ratio is going much lower, maybe to 0.5, maybe to 0.3, maybe lower. If the S&P stays at 6,000, that means gold at $12,000 to $20,000 an ounce. If the S&P drops to $4,000 in a recession, that still means gold at $8,000 to $13,000. And you're worried about RSI at 70? Here's what the smart money is doing. They're not looking at technical indicators. They're not waiting for pullbacks. They're accumulating, systematically, relentlessly, because they understand that in a structural shift, the only mistake is not having enough exposure. Ray Dalio has been saying it for years. If you don't own gold, you know neither history nor economics. He's not talking about trading gold. He's talking about owning gold as insurance against the system breaking. Paul Tudor Jones said in 2020, "I want to have 5% in gold." Not as a trade, as a permanent allocation, because he understands that in a world of unlimited money printing, gold is the only anchor. Stanley Druckenmiller, one of the greatest traders of all time, bought gold in 2020 and said, "The risk-reward for gold is as compelling as I've seen in my career." He wasn't looking at RSI. He was looking at the macro setup. These guys don't trade technicals. They trade regime changes. And they're all saying the same thing. We're in a regime change. The dollar system is breaking. Gold is the answer. But let's talk about the counter-argument, because I want to be fair. I want to give you both sides. The bears say gold is in a bubble. They say it's driven by speculation, not fundamentals. They say when the Fed eventually raises rates, gold will crash. And they might be right, in the short term. If the Fed surprises everyone and raises rates aggressively, gold could pull back. If inflation suddenly disappears, gold could consolidate. If the dollar strengthens, gold could weaken. But here's the question you have to ask yourself. What's more likely? That the Fed raises rates to 10% and crashes the economy to defend the dollar? Or that they keep rates low, keep printing money, and let inflation run hot? What's more likely? That central banks suddenly stop buying gold and go back to trusting the dollar system? Or that they accelerate their buying as the system becomes more unstable? What's more likely? That the BRICS countries give up on de-dollarization and accept American financial hegemony forever? Or that they keep building alternative systems until one of them works? You know the answer. Everyone knows the answer. That's why gold keeps going up. Now let me tell you about the real risk. The risk nobody's talking about. It's not that gold goes down. It's that gold goes up so fast, so violently that you can't get in. That the premium for physical gold explodes. That the ETFs suspend redemptions. That the COMEX goes to cash settlement. That you're stuck watching from the sidelines as the biggest wealth transfer in history happens without you. That's the risk. Not that you buy at $4,000 and it goes to $3,500. But that you wait for $3,500 and it goes to $6,000, and then $8,000, and then you're chasing it at $10,000, paying a 20% premium for physical, wondering why you didn't buy when it was overbought at $4,000. Let me give you a framework for thinking about this, because I don't want you to just take my word for it. I want you to think it through yourself. Ask yourself these questions. Do you believe the dollar will remain the world's reserve currency forever? Or do you think we're in the late stages of dollar dominance, similar to the late stages of British pound dominance in the 1940s? Do you believe central banks will stop buying gold? Or do you think they'll accelerate as the system becomes more unstable? Do you believe the Fed can raise rates high enough to make the dollar attractive without crashing the economy? Or do you think they're trapped between inflation and recession? Do you believe the BRICS countries will give up on de-dollarization? Or do you think they'll keep pushing until they succeed? If you answer those questions honestly, you'll understand why gold is going up and why it's going to keep going up, regardless of what the RSI says. Because here's the truth. Technical analysis works in stable systems. It works when the rules are consistent, when the players are rational, when the game stays the same. But we're not in a stable system anymore. The rules are changing. The players are desperate. The game is ending. And in that environment, the only thing that matters is owning real assets. Assets that can't be printed. Assets that can't be frozen. Assets that have been money for 5,000 years. Gold isn't overbought. Gold is repricing. Repricing for a world where the dollar isn't the only game in town. Repricing for a world where central banks don't trust each other. Repricing for a world where the financial system is fragmenting. And that repricing has a long way to go. So when you see those headlines about gold being overbought, when you see the technical analysts calling for a correction, when you see the bears on CNBC saying it's time to sell, remember this. They're looking at the wrong indicators. They're fighting the last war. They're using tools designed for a world that doesn't exist anymore. The smart money isn't looking at RSI. They're looking at central bank balance sheets. They're looking at reserve currency composition. They're looking at the architecture of the global financial system, and they're buying gold. Not because it's cheap, not because it's oversold, but because it's the only asset that makes sense in a world where nothing else does. The question isn't whether gold is overbought. The question is whether you understand what's happening, whether you're positioned for the biggest monetary shift since 1971, whether you're going to look back in 5 years and wish you'd bought more when it was only $4,000 an ounce. Because this isn't a trade. This isn't about timing the market. This is about understanding that the world is changing, that the dollar system is breaking, that gold is reasserting itself as the ultimate form of money. And when that process is complete, when the dust settles, when the new system is in place, you're either going to be holding gold or wishing you were. The choice is yours. But don't let a simple technical indicator make that choice for you. Don't let RSI blind you to the biggest opportunity of your lifetime, because gold isn't overbought. Gold is just getting started.